Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we're running through a few notes, scribble notes that I've made over the last few months. I was going to do some short reels out of them, but I thought I'd do a big long video. And I'm going to try and do a bit more time on the boat this year is one of my key goals. So if you call me and you hear water in the background, that is the reason why. So I've got it headlined, or the main headline for, I guess, this video can be things I wish I knew earlier. It's taken me many years to work out what works, what doesn't work, and what really works well. First one is, it's not about how much you make, it's about how much you keep and then invest. So I guess a lot in our society and expectations on people having to continue to climb the corporate ladder and get the most high paying job, it's not all about that. You'll find most wealthy people actually started off with very little, but made their key priorities to invest their money from a very, very early age. And I mean, I changed my mindset probably 7 or 8 years ago to making my number one priority is to build the property portfolio. Second to that is to build a business. And then third, if at the time still working in a corporate gig. But number one priority is to do everything to keep building the property portfolio, because in the long run, wealth lasts a lifetime and will support you and your family through generations, whereas a job you can only earn so much as a job, 2, 3, 4, 500 grand. You get taxed half of it, and I mean, even if you're good, you might last till you're 60. So between the age of 20 and 60, you got 40 years to make a corporate career, but investing lasts a lifetime and intergenerational, and will by far make you more money, and has made more millionaires investing in not just property but other streams of income. Businesses, stocks, commodities can also get you a lot further, and you don't need much money really to start. Another thing I wish I knew earlier was actually inflation is good for investors, especially people who hold property, and also people who hold shares in a business that inflation supports, such as banks or commodity mining businesses or property businesses, because inflation keeps inflating and increasing the value of businesses or property as well. And inflation also devalues the debt that a company or the debt used to buy the property. So over time, the inflation continually gets eroded with inflation, and the value continues to keep rising. So inflation is actually a good thing for property investors. It can grind your gears when they start jacking interest rates up, but I mean, that's only temporary, and you'll always be ahead in the long run, as by the time this higher inflation, higher interest rate environment is over, the values of properties will be more than doubled, and you'll have substantial equity, and the value of the debt will be negligible. Taking out $1 million in debt today, in 10 or 15 years time, will be like taking out 100 or 200,000. So that's why I'm always for taking on as much debt as I can, provided you can buy an asset that's under market value, that will continue to grow in value, that will cash flow, and the debt is just the cost of doing business. The interest on the debt, that is. Another one that I wish I knew earlier is a job is counterproductive to entrepreneurship. So when you're comfortable and you've got a paycheck coming in and you're not pushing the boundaries, pushing the limits, getting uncomfortable, you're not growing. You need to be in a position where you'll constantly feel uncomfortable. So get comfortable feeling uncomfortable, and then that means you are in a spot that you're continually growing. And getting a job that's comfy, that you just need to turn up, do your thing, sign off, is only so far that can take you. So that's why I say a job can be counterproductive, and you need to get outside your comfort zone, start a business, buy a property, and then see your wealth grow exponentially. So that, I guess, flows onto this note I've got here. You can only make so much in a job, and the sky is really the limit when it comes to investing in yourself, in a property, and in a business. Typically you're capped in terms of working a corporate gig. It's good to start off with. Obviously you need money to survive, but ultimately if you can start a side hustle, and investing in property is a very easy one to do. You just need to save up a modest deposit. I mean, to get started these days, 50 grand minimum to start. We can push it to 40, 45, but you don't want to be having no money in your bank account. So 50 grand to start, and then that's all you really need, and you can continue to leverage out and grow and expand and build your wealth. Leverage other people's experience rather than, I guess, trying to do everything yourself. The people I help today are doing better than what I did because they got the benefit of hindsight. I mean, I bought my first investment when I was 24, and sitting on 17 properties now across 3 states. They're worth over 7 million. But if I look at the people I'm helping now, I'm getting people, into their 3rd, 4th, 5th property before the age of 25. So if they continue that run, they'll ultimately outperform what I did because they're getting the benefit of hindsight of the trial and error that I went through in the beginning, trying to do everything myself. And then also leveraging other people's experience, leveraging the bank's money, so you don't have to save. For every dollar, you can borrow money from the bank, put it in an asset that continues to grow and increase in value, it services itself, and then leverage other people's money to keep growing and building. Rather than trying to minimize your debt limits, you want to leverage as much as you can to keep growing and moving forward. The biggest one I see, especially people the same age as me, in their late 20s, early 30s, is lost opportunity, massive lost opportunity. They're stuck in a mindset of trying to buy the family home, saving for many years, thousands and thousands of dollars, lost, or millions of dollars of lost opportunity if they just bought when they could have bought an investment, build a portfolio, then delay buying the family home. Because every year that goes by, inflation continues to increase property by minimum 6-7%, and as much as 15, 20, 25% in a boom, but on average 7 to 10% a year. So the value of your money you keep putting away to try and buy the family home continues to get devalued by 7-10% because you need more money to keep buying that same product. Rather just get in the market where you can afford, get on the ladder, start building your portfolio, start scaling, and then in the meantime rent where you live. It's always cheaper to rent where you live in a more desirable area. I mean, we live in Western Sydney near the bay. The house is probably worth $3.5 million, and we rent it for $770 a week, and rents are even softening now. So versus if we went and try and get a big loan and buy something for $1.5, $2 million, $3 million, it'll be costing us more, we're living in a lesser desirable area, and you won't be able to continue to keep building your wealth as aggressively as you can, because once you make all your debt investment debt, the banks lend you 50 to 60% more because they factor in the rental income. So don't wait around, just get in when you can. Delay buying the family home, because the first property you buy is probably not going to be your dream place or the most desirable area you want to live in anyway, and you're overcapitalized by renovating, and you have a growing family, you're pumping all your money into one location, then that becomes even riskier, especially when we go through a downturn, having all your eggs in one basket. And if you lose your job, you can't make big fat mortgage repayments, then the banks will be calling it back pretty quickly and selling to someone else. So that's why I think building the portfolio first is definitely a less of a risk. You're diversifying across multiple markets at lower price points. The bottom end always continues to keep rising. Even in a downturn, people look for sought after affordable accommodation. They can't no longer afford the $1 million, $2 million property, so they sell it or stop renting that to go and look for something more affordable. The demand shifts to affordable. Affordable end goes up even when the top end's coming down. So that's why we always like sticking to affordable and get as many as you can, and then ultimately leverage that into your family home, or sell half to buy your family home down the track, rather than using the family own and occupy place to buy, flip into the next, buy, flip into, because then you'll always be selling in the same market. You can't offset two markets. So when we're looking to buy a farm up in the central coast, mid-north coast of New South Wales in the coming years, but I'm going to time it. I'm going to buy in those markets when they're most suppressed in 28, 29, 30, after the land-driven downturn. But I'll be selling out of Queensland in the top of its market to then trade into another market where I want to live. So you can use your assets to get into markets and get a better deal, rather than buying in a market, being in that market, selling out of the same market to buy in the same market. You're never really going to get ahead too quick. So I think the old baby boomers strategy of buying the family home and using that to flip into one to the next is well and truly outdated these days, especially if you want to live in Sydney and Melbourne and desirable areas of Brisbane. So it costs money to make money. I always try to funnel away every penny, save every dollar. But really, to get decent amount of equity uplift or grow your portfolio, it costs money. You need to sort out after the best brokers, the best conveyancers, solicitors, buyers agents to work with, property managers. Even debt, taking on debt, I'm happy to pay 7, 8, 9, 10% in interest, because they'll get me into another property. And I know in the meantime, interest rates are high, but you'll be able to refinance to a Big Four bank and reduce your interest down the track. So not trying to penny pinch every single penny, because if you do that, then you won't go as further. You won't get the best desirable outcome or the best product that will help you on your way. So it definitely costs money to make money. And this is a good one. I mean, recently I heard Jeff Bezos say this, that humans overestimate risk and they underestimate the opportunity. So I'm always telling myself that. When you think, oh, maybe it's just a bit too much of a risk, is it now not the right time? The opportunity on the other side of that fear is probably a lot greater than the downside potential risk. So always weigh up the risk versus reward. even when buying property, like a lot of the time I find deals that are, 30, 50, up to 80, 100 grand under bank value, but on appeal they may look like too much work, or it needs a new kitchen, needs a new bathroom, needs a renovation, needs this, needs that, has a tenant locked in for 6 months, and it's too scary because we can't kick them out too easily. So taking on that risk, the opportunity is 80, 100 grand upside if you play it right and do the renovations well and manage the risk. So there's always opportunity on the other side of risk. It's just a matter of quantifying the risk and managing it so it ideally doesn't materialise, but even if it does materialise, you've quantified it and you've made allowances for it, and you've ultimately got a good deal on the way in, and the opportunity is only awaiting the other side of that risk. So thanks for watching. Until next time, see you then. If you need help buying an investment property, reach out today. Happy to chat. I'm getting booked out quite frequently now, so potentially may be able to get you into a deal in January. Ideally, I like buying in January when people are on holidays, not thinking about getting deals. But we are booking out quickly now, so best to be reaching out as soon as you can, so we can get you scheduled in and hopefully get you a deal in the next coming months. Until next time, thanks for watching. Happy property investment hunting.